you had the cash flow conversation yet? If not, you need to dive deep and make sure you understand how to make your money work for you. What's up, guys? My name is Erica Neal. I'm an authorized infinite banking practitioner, and today we are going to get into some real money talk on how money actually works when you flip the switch and stop going to work for your money so your money can work for you. So this is one of the biggest areas this is the biggest gap in financial education, I would say. I went to school for finance and economics. I worked as a traditional financial advisor for years, and the entire time we focused on asset allocation, how to pick a good stock portfolio, what does, different valuations look like, and trading, and all of the things that Wall Street tells us, which are get assets under management, right? Put as much money in as you can and get a good rate of return. Those aren't bad things. We need both of them. They're excellent pieces to factor into your overall plan. However, if you don't understand how to start taking money out of your account, what is this all for? Why are you saving money? Why are you investing money? Why are you going to work every day to not just pay your bills, but put a little bit of money to the side? What is the end goal? Well, I think most of us, a lot of people might say retirement, or I want to travel the world, or whatever. But at the end of the day, what we're all trying to accomplish is the same thing. We want the ability to stop having to go to work to go earn an income and have our money create an income for us. That is true financial freedom or retirement or whatever you want to call it, where you have passive income that exceeds your expenses without you having to get up and go earn it every single day. That's the end goal. Now, a lot of people are working on doing that through a real estate portfolio or a business, and that's all great. But there are a lot of people that are putting money into a 401k, IRA, stock portfolio, and they haven't mapped out what their money is going to do for them. And here's the thing, that's leading us into the retirement crisis that we're in right now. Why is it that we have such a retirement crisis? Why is it that we see so many people are having to come out of retirement and go back to work? They're living below the poverty line. They're having to move in with their children. It's not working, y'all. And if we really go back, let's look at the history of it. So used to, maybe not our parents, but our grandparents or great-grandparents, whatever, they went and worked for a company for 30, 40 years. They got a pension with that company. And when they stopped working, they still had an income. That pension paid a guaranteed distribution of cash every single year throughout their entire retirement. Pensions, by definition, they are called a defined benefit plan. Defined benefit plan. Well, what happened was we saw this switch where we saw companies go from doing pensions to offering a 401k. Now, a 401k is called a defined contribution plan. So you have a defined benefit plan, which means if you put money in here for X amount of time, this is the benefit, this is the income you're going to receive from that plan. Well, when we switched over to a 401k type defined contribution plan, well, as you can probably imagine, the only thing defined in there is what you can contribute. What can you put in? There's no telling, there's no promise to what you're actually going to receive at the end of the day once you've done all the work into your 401k. Now, that doesn't mean your 401k is bad. And again, y'all know me. I'm not a good tool or bad tool. I try to go into this as pragmatic as possible. Let's look at the tool. What is it designed for? What is it not designed for? And make sure that we use it for the appropriate job. Now, unfortunately, that kind of coming back to the retirement crisis, so many people are using their 401k and their IRA as an all-purpose, like a Swiss Army knife, right? It's supposed to build money, it's supposed to be a tax haven, and it's supposed to create an income for you later on in life. It's not working, and we're not even going to go down the tax route. That's a whole nother video. But the problem is people who are trying to use their 401k as an income source in their later, I don't like the word retirement, right? Like I'm not gonna just sit in a recliner and watch Wheel of Fortune. I love Wheel of Fortune, but I want to do a lot more than just that. But whatever you want to call it, retirement, distribution phase, freedom, whatever. The point is, when you get to that phase of life, You're using the 401k is going to have a completely different dynamic than what you've had your entire life. Your entire life, you've been saving money into it, allowing it to grow, build, and compound, right? Well, your relationship with that account changes when you get into a distribution phase. When you start trying to take money out, that's where we start to see the problem. You're now using a hammer to cut a piece of wood in half. So, there is something that we call Monte Carlo simulations, and you can Google it, look it up, whatever. Talk to your financial advisor about it. I didn't even know about this the first couple of years of my career, but Monte Carlo simulations are a way that, because the market is unpredictable, because nobody knows what any stock or S&P or any fund is ever going to do, Monte Carlo simulations are a way to guess how much you can take out of your retirement account and have a probably good chance of not running out of money. Now, when we talk about the success of Monte Carlos that you see online, most of the time, Monte Carlo simulations, if you were to go run them online, we're going to run one here in a minute. The definition of Monte Carlo having success is that you have $1 left. So what that means is, if you are going into this simulation and it says that you're going to be successful for 20 years, that doesn't mean that you have a consistent income in retirement for 20 years. That means that you can go for 20 years and have $1 left, and that is considered to be a success. So I want to set that parameter up front. Now, we're going to look at how can we create a stronger, more reliable, and overall just a better, higher income rate for you than just shoving all your money into a 401k and then hoping and praying for the best. Okay, so let's get into it. All right, so we are going to start with an accumulation calculator because that's one of my favorites. Plus, it has a Monte Carlo calculator on there. And let's use we'll go to the market history in a minute. Let's say that you're going to be in retirement for 40 years, which is totally, let's be real. If you retire at 65, living to 105, y'all, the life expectancy is skyrocketing. And, a lot of people like to say, oh, I'm only going to live to 80. I'm only going to live to 85. Listen, I don't know. You don't know. Lord Almighty is the only one that knows. So I'm going to put in 40. And here's the thing. If I plan to live for 40 years in retirement and I only live for 30, okay, right? Like, that means I hope for the best, plan for the worst kind of thing, right? So I planned ahead and I'm okay. Now flip that. If I only plan to live, let's say I only plan to live 20 years in retirement and I live for 30, oh crap, right? Like, that's not good. If you plan for 20 and you live for 30, that means you ran out of money 10 years too early. So I don't know about you. I do not have any desire to be a burden on my family. Now, let's say you have saved not 200,000, although the average American has, when they retire, 200,000 in their 401k, but that's another conversation. All right, you have saved diligently. You have done the hard work, and you ate peanut butter and jelly and didn't go to Starbucks every day, and you have saved up $2 million in your 401k. Congratulations. You are a multi-millionaire, okay? Now, we're not going to get into all the cost basis and all that. Let's look at taking out a withdrawal. Now, when you are in retirement, let's start here. A lot of people have heard this through the financial gurus. If you get an average rate of return of, let's come over here. So we're going to look at 40 years market history. Okay, so somebody who retired 40 years ago, the market, the S&P with no dividends, the average rate of return was 10.68. Now, I know you guys know how I feel about average rate of return, but that's another video. We are, however, going to use this particular time period. Now, we're going to put in, all right, so we've put in those values. This is what you're earning when you're in retirement, okay? Now, if you had a crystal ball that told you you were going to get an average rate of return of 10.68, what did we see that it was? Yep, 10.68. Would you feel comfortable pulling out 10% a year? Most people would would say, yeah, that's pretty realistic. So let's go into the withdrawal. So $2 million at 10% is going to be $200,000 a year. Now, most people are going to need a percentage increase. Let's be real. And I'll tell y'all, if y'all know anybody, just think about it. Okay, 20 years in retirement. I think about 20 years ago what anything and everything cost, regardless of whether you live a more extravagant lifestyle. Just going to the store is going to be more expensive. So we are going to put a cost of living increase in here. We're going to say we need to increase our income by about 3% per year. Okay, so we've got a 3% per year. Okay, and you can see it's automatically included. They're factoring in that 3% increase every year. Now, here's the cool thing. It's showing us every single year what you're taking out, what you're earning, okay, and everything in between. Now, if you were to do this starting year one of retirement, what it's showing you is, I'm going to zoom in. Oh, no, let's just make this bigger. So you're taking out $200,000 every single year, and then it's increasing 3% to adjust for inflation. Now, unfortunately, you run out at year 23. You officially go negative. Let's be real, though. Let's look at the account balance here. So you go in, you take out that 200. Yeah, so you technically run out of money at the end of year 22, moving into 23. Because at year 23, you only have $137,000 left, right? Now, let's be realistic. If you are taking out $200,000 a year and you start to see your account balance do this, right? I'm probably not going to take out the full $200,000. And that is what I have been to financial seminars where they're talking about this issue, this retirement crisis and the income. And one of the guys, he was with a large investment fund. We won't go into the names, but he said this was his answer when somebody asked him, what about when your client is losing money and they still need to take an income? What do you do? And their answer was, they just need to take out less. Maybe you don't take that trip. Maybe you don't buy that car. Maybe you don't, whatever. Here's the thing. There's only so little that we can take out. And that's asinine to me that, oh, hey, yeah, you worked this hard for this long, but now that you're in retirement, just don't use it. Just don't use that money, right? Here's what's happening. Why is it that you're running out of money? If your average is 10.68, your average is more than what you're pulling out. Why is this not lasting forever? Why is this just not, a cyclical, that 0.68 that, you technically have earned more? Why is that not just cycling back into your account and helping it grow? Here's what happens. We need to understand, like I said, the relationship between you and your money has changed when you get to that retirement phase. You're not just putting money in, you're taking it out. That is going to impact the dollars that can earn and grow or the dollars that are lost in a bad year. Here's what I mean. Year one, you take out 10%, but you earn 26.3. No problem. In fact, year two is the same way. You take out 10, you earn 14.62. That's awesome. Now in year three, you take out 10, but you only earn 2. So we finally take, a little bit of step backwards, but we're still okay. Year 4, year 5. So what year was this? This is a fantastic start. I just want to point that out. You have 5 out of 5. The first 5 years of this person's retirement, you only have 1 year that's less than 10%. This person hit the jackpot, right? They started off strong. What year is this? 1985. Anyway, I just wanted to bring that up. 5 amazing years to kick off your retirement. Now, here in year 6, though, in year 6, you take out 10%, but you lose 6.5. Here's the thing. In retirement, you're not only losing money, you're depleting it with a withdrawal. Now, maybe you don't want to take out 230. Maybe you only take out 200. Maybe you only take out 100. Whatever. That's fine. The point of the matter is you're still taking money out. So if you take out 10% and you lose 6.5, that is a negative 16.5% hit to your account. Double negatives in money don't make a positive, unfortunately, okay? Now, here's the thing. You go from 2.5 to 2.1, so you don't just take out the 231. You lose almost 400 grand here. Now the next year, and the response is, oh, well, if the market goes down, it'll get back up. You're right. It usually does. Here's the problem. The next year, the market comes back with a vengeance. Holy crap, 26.3%. That's great. However, but here's the thing. You took money out. You had to take your income out. So now you're only getting it on 2.1. You're not getting it on the 2.5 that you had before. So you're earning that amount on a lot less because you're continually having to withdraw. Now the good news is it does go back up. Same thing. But again, you had 3 good years and then a little bit of a negative, right? Not a lot, but it still hits your account because you're taking money out. So again, y'all, I'm looking at this and I didn't think about what a freaking amazing stretch the market had. Look at this. Holy crap. Like if you can retire in this year, that's amazing. We're going to look at some other years because that makes no sense. That's amazing. But here's the problem. All good things come to an end. We see at that point, then the market has 3 consecutive down years. 3 consecutive down years. We lose. Let's look at what years these are. Yep. So we had leading up to the dot-com boom and bust. We have a -10, -13, -23. So year 2000 through 2002. So the good news is that in this scenario, you retired and you made it a good long while. You made it 23 years without running out of money. And that's because the only reason that you made it that long is because you had a really good streak of luck in the first 10 years of your retirement. That's amazing. But what we're noticing is that 10% is still too much. Okay? Now, let's just make it random. We're going to take all of these earning rates. Okay? All of these earning rates. Like I said, it depends. The sequence of returns, and that's what we're looking at in retirement. The number one risk that people face in those later distribution retirement years is what's called sequence of returns risk. In what sequence are you going to see returns that the market spits out? Is it going to look like this? Because this is pretty awesome. Okay? Let's look at another sequence of returns and see what that does to the account balance. Let's go just random. We're just going to push the random button. Okay. Holy cow. So in this scenario, we don't have 5 amazing years to start. 2 of the 5 are pretty bad. And in this scenario, you ran out of money in year 13. So instead of making it 23 years, you only make it 13. Let's hit the random button again. This one's not bad. Not bad. Now you still have a pretty heavy negative year in the first 5 years, right? So that's intense. But now you make it almost 17, right? You technically run out of money in 16, but in year 17 is when you run out of money. Okay? Let's hit random again. That one's not bad, right? The first 5 years are not terrible. Actually, the first 10 years aren't great. But then again, the problem is not if, but when you have these massive drops, that's going to kick you right in the shin. So random. So we just keep clicking it over and over again. So same thing on this one. We have, out of the first 10 years, we have 4 negative years. And that drops it down to 12 years. You run out of money in 12 years. So I could literally push this random button all day. Let's run. Remember I mentioned Monte Carlo? So Monte Carlo simulations, this is what they're doing. They are going to I'm going to tell them how many iterations, how many combinations of what we were just seeing, how many ways do you want them to mix up this 40 years of returns? I want them to give me 500. I'm going to have it run 500 different scenarios of how these returns are sequenced in order. And it's going to tell me what happened to the accounts, right? What is the best case scenario? What's the worst case scenario? Because here's the thing. We don't know what's going to happen. We cannot tell the future. I do not know if I retire in year X, what's going to happen in year Y, Z, A, or anything in between. So when you retire, it is a gamble. And that's kind of what I think of with Monte Carlo. If you think of Monte Carlo, you think of, I think about casinos and gambling and all of that. Kind of the same thing. When you're retiring, you don't know. You can kind of try to count cards, but you do not know. what's going to happen. And that's exactly what's happening in these Monte Carlo simulations. So this is what we're going to look at is we're going to take 500 iterations and we're going to see what are the probabilities of your success in retirement based off of these returns. Now, before we do that, we cannot forget, you need to hit like, subscribe, and share this with a friend so that we can continue to share the good news and help people understand how money works. So now let's go into the Monte Carlo simulation. And okay, so this is asking what's the minimum account balance to be determined successful so we can decide. So I'm going to put 0. That's obviously ridiculous, but that's a worst case scenario. To me, I'd like to at least keep, a couple 100,000, but we're just going to put 0 is considered to be successful, okay? So it's running the simulation. All right, so what it says is this strategy, taking out 10% a year, succeeded 8 times out of 500. You have an 8 in 500 chance of not running out of money for 40 years, taking out 10%. The largest, in the best case scenario at the end of retirement was 11,410,000. That was great, right? So best case scenario, meaning if you hit that 8 times out of 500 and you were just the luckiest dog out there, you're going to end up with $11.4 million. On the other end of the spectrum, the worst case scenario, the earliest account depletion was 6 years. So you have an 8 out of 500 chance of getting 11.4. That's the best case. The worst case scenario is you run out of money in 6 years. That's what this is showing us. Now, this is not to scare you. Please don't take this as a fear tactic. This is real. This is real money talk, and we're talking about real money issues. This is the problem, y'all. This is why people are failing in retirement. This is why our parents and our grandparents that have worked their asses off their entire life are seeing their accounts be depleted in the most vulnerable stage of their lives. We are not going to continue. We are going to change the trajectory of what we're doing. And that's why I'm passionate about cash flow assets. I'm investing in real estate. I'm buying businesses. I have stocks as well, but I also put as much money as I possibly can into my life insurance policy, right? I'm using my infinite banking policy. I'm doing all of these different things that I don't just have all of my money tied up in this vulnerable, volatile, asset that's going up and down. No. Am I going to get the best rate of return on my life insurance policy? No. Am I going to have a guaranteed tax-free source of income when I get to retirement so that I can rely on something other than a volatile stock fluctuation? No. So I'm not doing that. Now, here's what we're going to look at. Let's get out of there. We're going to go back to the original. Okay. So we are back to what we talked about. This is a pretty good, scenario, not terrible, but the problem, like we already identified, the problem is when you want to take out more than what you earn in that year, you're in trouble. Okay, your bottom line, you're in trouble. And you could say, I'll just take out less. In these scenarios, technically, when you lose 6%, you shouldn't be taking anything. You shouldn't take anything. In fact, you should be technically putting money in. But nobody's going to do that in this phase of life. Okay? What if, instead of kicking your account when it's down, what if you had another bucket of money that was sitting on the sidelines ready to go? In fact, I had this conversation with a CPA yesterday. He was like, I don't understand why. He's like, I don't, what did he say? He's like, he's not like anti, whole life insurance policies, but he's like, I don't really see the value in that. And so we asked him, we said, okay, his name was Mike. Okay, Mike, I get it. But when your clients are in retirement, and he's an older gentleman, so he works with a lot of older clients, what are you going to do, or what do you tell your clients to do whenever you have a market crash and they're trying to live off their income? He's like, oh, well, we just put cash on the sideline. And so we tell him, he tells his clients that they need at least 3 years worth of income in cash sitting on the sideline. So when the market crashes, they can just go take from that bucket of money because it's uncorrelated to the market, right? Like it's sitting there, it's just cash. And I'm like, brilliant, Mike, I love it. Absolutely. Absolutely. That's exactly what infinite banking policies are. It is cash sitting on the sidelines. The difference is that this bucket of money, this infinite banking policy, is earning a guaranteed rate of return plus dividends that's allowing you to outpace inflation. Is it gonna get you this 10.68% return that the market's giving you? No, no. But it is a bucket of money sitting on the sidelines that's earning consistent every single year, 4 and 5%, sometimes more, right? It always varies. But I mean, even if it's conservative 4 and 5% that you're getting on an annual basis, uncorrelated to the market, that's still going to be better than what your bank account's offering you. Okay? So, if you have that bucket of money sitting over here and you can pull from that, it's uncorrelated to the market, you can take that money out and it is not impacted at all. In fact, it's going to go up regardless of whether you take money out or not. Let's say we want a minimum return for withdrawal. So what I'm saying is, what is the, if the return is less than this, they're going to take out 0. If my return, let's just say, if the return is less than, what do you want to say, 10%? Because if you're taking out 10%, you don't want to earn less than 10%. So if the minimum return for the withdrawal is 10%, let's go with that. Awesome. Look at this, y'all. Just by not taking money out when the market drops below 10%, look at this. At 40 years in, it's $13.87 million. Remember that Monte Carlo simulation we saw? In the best case, 8 out of 500 times, not even 8, the 1 out of 500 times, the best case scenario was 11.4. Just by having a separate bucket of money sitting ready to go, uncorrelated to the market, that you can draw from in the event that the market drops below 10% or whatever it is that you're withdrawing, you turn out better. And it's not a, and let's run some random scenarios here. Random. Okay, so there's one. Let's run a Monte Carlo simulation on it. 500 implications. 0. This strategy, let's see how often it succeeds. Just by having a separate bucket of money, like a life insurance policy, sitting on the sidelines that you can pull money out of in the event that your stock portfolio drops below 10% or whatever your withdrawal is, your success goes to 333 times out of 500. Having only stocks, you had an 8 out of 500 chance of being successful. Just by incorporating a life insurance policy or whatever separate bucket of money sitting on the sidelines. In fact, this is just saying, honestly, just cash. This isn't even factoring in life insurance. The life insurance is going to make it look even better because it's continuing to grow. Regardless, 333 times out of 500, you succeeded. The largest remaining account balance was $28 million. So best case scenario, you end up with $28 million. The worst case scenario was the depletion in 13 years. This is so much more impactful. This is so much more likely. This is so much more valuable to someone in that distribution phase to know that worst case scenario is 13. The other worst case scenario was 6 years. And then what? The best case scenario was 11. And the best case scenario here is 28 million. And you have 333 times out of 500 versus 8 out of 500. That's the difference here, y'all. Just by incorporating a little bit of strategy and understanding how income works, you put yourself in a much higher likelihood of success. And your success is 28. The best case scenario is 28 million versus 11. So your best case scenario is more than double what the best case scenario is on the other side. And your worst case scenario is still more than twice as good as the worst case scenario on the other side. You have a 13-year worst case scenario versus a 6-year worst case scenario. All I'm saying is, if you're putting all your money into the stock market and think that it's just going to be the best thing ever, you are setting yourself up. Let's go back to the original. I want to look at one more thing. So when we have these life insurance policies, again, I put everything I can into mine. These scenarios here. Now, here's the other thing. Somebody might say, oh, well, if I'm retired, I'm not putting all my money into the S&P, I'm going to have it moved over to bonds, right? Totally reasonable. Totally reasonable. You could do the Dow Jones, okay? But when people say bonds don't go down, yes, they do. Look at this, right? Like, bonds do fluctuate. I don't care what Dave Ramsey tells you. Bonds do fluctuate. Let's look at a 10-year Treasury bond. This one's not bad, a 5.8 return. Copy. So we're going to take off this withdrawal. We're going to plug in this, paste the values. Okay. If you put your money into bonds and you're trying to take out 10%, it still runs out in 14 years. Now, let's say the withdrawal, maybe $100,000. At that point, you're only pulling out $100,000. Now, mind you, this is whenever you retire. You're pulling out $100,000 out of $2 million. That's only, what, a 5% withdrawal rate. You're only pulling out 5% of your money, and you still run out of money in 35 years. So, is this a little bit better? Yeah, but I mean, really, if you want to pull out a reasonable amount of income, you're still running out of money in 14 years. So, this is just to, again, this isn't a scare tactic. This isn't a, oh my gosh, the sky is falling. This is just a point to say, like, hey, realistically, let's look at some random, it just gets worse and worse. So, they're all kind of about that same, like 10, 11, 12, 14 years, just because they have more consistent earnings rates. So like I said, this is not meant to be a scare tactic. This isn't meant to be like, oh my God, the sky is falling. But it is something to kind of, let's think about this, right? Like, what are we trying to accomplish? And do you have all of the tools that you need in your financial toolbox to do all the jobs of money that you need your money to perform? You might be earning and growing and getting a good rate of return, but do you have the ability to take income and cash flow for the rest of your life? Right? That's what this is supposed to be. You're working hard for your money right now. Good job. Is your money set up to work as hard for you later on? So again, don't forget to hit that like button, share, subscribe so you can stay in tune with all of the videos that we'll be continuing to post. Also, comment. Let us know what you think. And if you have any ideas on what you want to learn more about, don't hesitate to let me know. I can't wait to see you next time. Until then, keep it real. At Infinity Investment Strategies, we teach investors and business owners how to become the bank. In using the infinite banking strategy, you can lower your taxes, increase the control you have over your own money, lower your risk against multiple wealth eroding factors by adding additional layers of asset protection, and increase your leverage with guaranteed growth and the opportunity for dual rates of return. With authorized infinite banking practitioners with experience in business and investments, we are here to help enhance your portfolio.